possible to just buy a couple of index funds, maintain them for a long time doing absolutely nothing, and end up earning more money than if you have just spent all that time trading frenetically, doing lots of analysis and lots of screen staring, implementing complicated algorithms and models and etc. Yes, actually, yes, it is possible, and in this video I'm going to explain you why and under which circumstances this extremely lazy and simple strategy could work. Welcome to Manufactured. If you're ready to learn the truth about passive investing and all the evidence behind it, stay here. Otherwise, you can go join an MLM or something. First of all, what is an index fund? An index fund, unlike an actively managed fund, is a fund that just buys all the assets that constitute an index in the exact same proportions. Just that. Does anyone bother to analyze and monitor the assets inside the index? No. Does anyone bother to value these assets in order to decide whether they are overpriced or underpriced? No. Does anyone try to find the best moment to buy these assets or to sell these assets? No. Does anyone monitor possible opportunities like inefficiencies or anomalies as something to take advantage of? No. Does anyone monitor possible threats, and does anyone hedge the fund against those threats? Also no. Does all this laziness work? Surprisingly, yes. As I mentioned in my previous video, the people reports, which study all the returns of actively managed funds and compare them to their benchmarks, have found out that most of these funds underperform the indexes. And this happens in many different countries and both with stock and fixed income. But what's the reason for this underperformance? Well, there are many reasons. One of the reasons is cost. Implementing all these complicated strategies have higher costs than just buying assets in the exact same proportions that an index. All these complicated decisions that need to be made regarding which exact assets to pick, in which proportions, and when to buy them, when to sell them, all this has a lot of work behind. You need people to make those decisions. You need research, you need technology, you need systems, and all those things cost money. If you're constantly tweaking your portfolio and tweaking your strategy and buying and selling things all the time, all those movements generate trading costs. So the return of doing those things needs to be higher than those costs, which is not that easy. And finally, one of the biggest costs of all is the cost of making mistakes. From all the assets that the market have, choosing the right ones, that is, choosing the ones that are going to have the higher returns and buying those assets in the best possible moment and selling them in the best possible moment in order to maximize the return that that asset has, those are extremely difficult things to do. And making mistakes in trying to do these things can be extremely costly. By attempting to do this, you essentially going to pick a small number of assets in which you will invest your money. If among the assets that you chose, you don't have the ones that had the highest return in that market, then your average return is going to be significantly lower than the average. The same happened with timing. If you have just sold everything you have and you are waiting to the perfect moment to buy it all again, while you do that, you may end up losing the best days of the market. And when you lose the best days of the market, there are plenty of studies that show that your returns get significantly lower. And I'm not talking about a lot of time. If you just lose the 5 best days in a 10-year period, your return is going to be significantly lower. So the whole logic behind passive investing is to avoid these mistakes and avoid all these complicated strategies costs by doing absolutely nothing and maintaining assets for a long time. But of course, There are certain things that you have to bear in mind in order for this strategy to work. And those things are, first of all, you need to do this long term. Otherwise, it's not going to work. Why? Well, your returns doing this will be average. There's no way that you can make more than the average. And in fact, you're going to make a little bit less than the index because, well, even though this strategy has low costs, it still has costs. So it's not a strategy that will make you rich from one day to the other. It's a strategy that you can use to build wealth gradually over a lot of time. Another very important thing is that this strategy is based on the assumption that everything will be alright in the end. That is, that everything ends up growing in the long term. That is just an assumption. There's no way to prove that things will actually grow in the long term. However, making predictions in the long term is far easier and tends to be far more successful than making predictions of things in the short term. And that is because in the long term, prices tend to get closer and closer to the intrinsic value. That is the discounted value of the cash flow that that company generates, or that bond or whatever asset you're talking about. The price for a particular moment, that's a little bit more tricky. The second thing is that you need a big, broad index. That is an index that includes a lot of assets inside. Why? Again, because predicting the behavior of the sum of a big quantity of items as a whole, it's a lot easier than trying to predict the individual behavior of each and every item inside of that. For example, it's a lot easier to say that the S&P 500 will be up than to say which exact companies inside that index are going to be up and which exact companies are going to be down. So if you're trying to buy index funds to implement passive investing strategies, it is very important that you choose an index that is broad and diversified, not an index that represents a tiny portion of the market, like just one sector. Because if you do that, you are doing something very similar to asset picking, which we learned that tend not to work very well. And finally, you have to choose something that you have some pretty good reasons to believe that will grow in the long term. Not everything grows in the long term. How do you make this prediction? Of course, you don't have a crystal ball and you can't tell, but you can at least take a look at how this index has been behaving in the past. Of course, past performance is absolutely no indication of the future. However, looking at historical data will give you an idea of how the index behaved under different circumstances. Then you can make a prediction of how do you think those circumstances will change or not change in the future. If you think that things will stay the same, you can make a reasonable prediction that the index will continue to perform in the same way. Then if you think that circumstances are going to change significantly, you can then predict how the index will react to those changes. Will it go down? Will it go up? Ideally, you want to pick an index that you have pretty good reasons to believe that will go up. If after understanding these three important things you decided index funds are for you, these are the steps that you need to follow. Step number 1, you have to define your asset allocation. What is asset allocation? Asset allocation is defining what kind of assets you're going to have in your portfolio and in which proportions. An asset class is a group of assets that are similar and that are highly correlated with each other. The most common asset classes are stock and fixed income. And then you have all the things like real estate and commodities, and some people consider crypto another asset class, which is very debatable, but that's not the topic of the video. So if you're an absolute beginner, you can start with at least 2 asset classes. You'll be fine with those 2. Another thing that you need to decide is in which proportion. You can start with 60% stock and 40% fixed income and increase the percentage of stock if you have more willingness and more capability to take risk. The willingness to take risk is extremely personal. It's a matter of preference, and some people love adrenaline. Some people hate volatility. They just can't stand it. They can't sleep properly when there is too much of it. Some people are miserable when the market is down. Some people don't care. It's a matter of preference. See what you can handle. Capability refers to how much risk you can actually afford to take. That's not a matter of personal preference. That's a matter of your situation. The more income sources you have, the more capability to take risks you will have. Also, if you have a lot of assets, if you're young and healthy, and if you don't have kids or old parents or any kind of relative that depends on you, if you don't have a lot of liabilities, all those things make you more capable of taking risks. You have to decide which level of risk you want to have and which will be the combination of asset classes that will give you that risk. Generally, fixed income is safer than stocks. If you need less risk, you need more fixed income. The second step is to pick at least one, maybe two indexes that represent the asset class. We could discuss whether it is worth it to have one index, two indexes. Can I just have the S&P 500? Or I need to add medium cap and small cap and international stocks and emerging markets. We could discuss all that, whether it is worth it or not. But to begin with one index fund for each asset class, you'll be just fine. As long as the index is broad enough, like I mentioned before, you'll be fine. And then we get to step number 3. You have already picked your asset classes, you have already picked your indexes, which are all broad and big, and you know that those indexes are going to grow in the future, or at least you're pretty sure that that will happen. So now it's the time to pick an index fund. Not all index funds are the same. How do you find information about index funds? Very easy, you can Google that. There are plenty of people that make rankings of the best index funds for one particular index, the ones that have the biggest returns, the ones that have the best risk level, whatever. Another very useful tool is Morningstar. These places have a lot of information about funds. It's really complete. How do you pick the best index fund for a particular index? You have to look at the returns. It's not the same to look at the 10-year return than to look at the 1-year return or 5-year return. So make sure that when you compare, you're comparing the same time period. Otherwise, you will be comparing apples to oranges, and that is not going to be useful. Do you need to take a look at the standard deviation or some measurement of risk? In general, if you're looking at all index funds that are based on the same index, there shouldn't be a huge difference in the standard deviation because essentially they all have pretty much the same thing inside. If the funds that you're trying to compare have different levels of return and different levels of standard deviation, however, these differences in the standard deviation are not very huge, what you can do to compare them is to pick the one that has the highest Sharpe ratio. If you're wondering why different index funds have different returns, the explanation lies generally in something called the expense ratio. Every fund has costs. Even though in index funds these costs tend to be lower, they're still there. You still need people to manage the fund, to decide how much money to invest, how to maintain the portfolio plans, how to maintain the exact proportions that you need to maintain in order to replicate the index properly. You need to define how much cash are you going to have. And by the way, cash also represents a cost. Cash doesn't generate returns. And of course, you need some minimum level of cash. So the expense ratio and cash, those things tend to explain most of the difference in return. Another thing that has an impact on returns is the turnover. Generally, the more turnover that a fund has, the more expenses and the less return. In the end, what you need to look at is the return. But if you want to understand why the return is different, you can look at all these other details. Another very important thing that you need to consider when picking an index fund is sale loads. Sale loads are like a commission that some funds charge you. This is something that you're charged separately. It's not in the expense ratio. So it's something that you need to consider if your fund charges this. Of course, there are many funds that don't charge side loads. So my recommendation, go for those. And finally, another thing that you need to consider is the minimal initial investment. For many funds, the minimal investment is zero. That is that you can invest whatever you want. So if you think that you can't invest because you don't have a lot of money, that is not a good excuse. A final word. Are ETFs the same than index funds? There are many indexes that have an ETF, that is an exchange traded fund that tracks that index. So exchange traded funds are very similar to index funds. The only difference is the way they function. Index funds have one close price each day, and that close price is based on the close prices of all the assets that the index contains. An exchange traded fund is something that you can trade just like you can trade any stock. You can trade it at any time you want, as long as the market is open. With exchange traded fund, the price that you buy or sell it is any price that you enter, provided that there is a counterpart willing to accept that price. So it might happen that this price differs from the actual value of the assets inside the index. That's another layer of complexity that you don't have in index funds. The main advantage is that they are barely easily traded. The disadvantage is that trading these funds this way generally have fees, so you end up having a lower return. However, personally, I have the ETF, and the reason that I buy the ETF is because I can buy it very easily, very quickly, with just one click in my local market with my local currency. However, if I want to send money to an index fund, well, that's a little bit more complicated because I live in Argentina, and here in my country we have lots of regulations and a lot of bureaucracy regarding how we move money around. So for me, it's a lot easier to just buy the ETF. And it is not such a big difference in return, so it's not so terrible if you only have access to the ETF. But if you can choose between the ETF and an index fund, you will normally get better results with the index fund. That's it for index funds. I will see you next week with another topic.